I see it time and time again. Too many crypto bros are hyper focused on where Bitcoin is going, where Ethereum is going. Very few people look outside of the box, outside of the ecosystem. Some might talk about the money supply, some might talk about US interest rates coming down, bringing liquidity into the market, pushing up prices, but really, I think this misses the mark. Crypto is still traded as a risk-on asset. When stocks go down, then Bitcoin and as an extension crypto tends to go down even more. We have seen this during the COVID crash. We're going to continue to see this in the future. The reason why this matters is this chart here. This is the S&P 500 relative to the money supply. It's a long-term chart that starts in 1959. Sometimes stocks outperform the money supply, sometimes they crash versus the money supply. This year was the dot-com crash, this was the global financial crisis. And at the height of the global financial crisis, Bitcoin was born. Bitcoin was an invention versus the monetary debasement. All the banks got bailed out with newly created money. A lot of price inflation followed, but really what's important here is that risk on assets, since the creation of Bitcoin, appreciated versus the money supply. And since crypto is still traded as a risk on asset, if stocks now suddenly correct in the same way as it did during the dot-com crisis, then Bitcoin will come with it, with leverage. So a correction of the S&P 500 of 57% is probably much more for the crypto market. Now this scenario that I'm painting here, this potential future correction which then gets amplified within crypto. It's not a scenario that nobody is prepared for. More and more people actually expect a development like this. And here is where we can see this. This is the gold market. Gold has never appreciated that quickly. There's a real bubble in gold almost. Here's a long-term gold chart relative to the money supply. The dotted line is the average price over all of those years. Again, a chart that starts in 1959. And yes, there has been a time at the end of the 1970s where gold was almost 3x higher compared to the current price, but still, on a historical scale, we are quite high. People are prepping for potential crash in stocks, and the crypto ecosystem is completely ignoring that fact. That's the problem. The Bitcoin maximalists still think that Bitcoin is gold 2.0, the digital gold, the protection against monetary debasement. And to a degree, that's true, but to another degree, the at least medium-term price action is still very much influenced by how much risk appetite there is in the market. If the market wants to be risk on, then high beta plays like Bitcoin are very much in demand. If the market is risk off, then things like gold get bought. And maybe gold will see a historic rally, potentially beyond what we have seen at the end of the 1970s. And the reason for that is the demand for gold through central banks around the globe. Nobody wants to hold US treasuries anymore. And so the US dollar ceases being the reserve currency, and gold might be that reserve currency, or some kind of new system might be that reserve currency. The long-term ramifications of this are of course very unclear. We don't know what happens once the US dollar is not the reserve currency anymore, once the USA is maybe not that financially stable anymore. There's a good chance that people are going to exit US dollar denominated assets. The central banks are already in the process of doing so. And so when we take that macro picture into account, it's not really a surprise that Bitcoin dominance, so Bitcoin as a fraction of all of crypto, is going up, that Ethereum dominance is struggling, that Solana dominance is struggling. The higher we go up the risk curve, the less demand there is now. Here is the Bitcoin dominance. It has been rising since the end of 2022. This was the correction due to the meme coin trading on Solana, and this year was a correction due to the Ethereum ETF and Ethereum treasury company purchases. But now Bitcoin is recovering, and I think it's very much on its way to 73% dominance, as it was several times in the past. I don't think that Bitcoin dominance will stay at its current 60%. And so Ethereum dominance is likely coming down from here. Solana dominance has a good chance of also further coming down, potentially even to really low levels. This, by the way, here was the FTX collapse. And so as an extension, here's Ethereum relative to Solana. Ethereum might gain versus Solana because Ethereum is less risky than SOL. So money is flowing lower and lower down the risk curve. gold is rallying for a reason. Now, what's important to understand here is that the price discovery of cryptocurrencies isn't necessarily that tightly coupled anymore to the usage of the blockchain. So let's say we look at the number of active addresses on Bitcoin, on Ethereum, and Solana. We don't necessarily have that strong of a correlation anymore between how much the blockchain is used versus where the price is going. This here is the number of Bitcoin addresses over time. And at the beginning, we just had constant growth, which underpinned the price growth as well. But we peaked at the end of 2017. Since then, we just went sideways in the number of active addresses. But the price of Bitcoin went from 20K all the way to today's prices. So we don't necessarily need to increase in the number of active addresses for the price to appreciate. The number of active addresses on Ethereum, for example, continues to grow. Yet the Ethereum dominance is struggling in the last few years. Ethereum is doing worse compared to Bitcoin, of course, if we ignore the recent rally. Overall, since the move from proof of work to proof of stake, Ethereum underperformed the rest of the market by more than 40%, despite the number of active addresses going up during that time, while Bitcoin did not see that increase. And so the main argument for Solana coming down is not necessarily that the number of active addresses is coming down. This is not necessarily helpful, but it's not the main driver. This is the number of active addresses on SOL. This went up massively during the meme coin trading frenzy and is now constantly on a decline. But again, I think that Solana dominance will fall from here simply because the market is looking to de-risk. Solana is artificially inflated. While the trading volume on Ethereum was 8 billion in the last 24 hours, and in Solana it was at a very similar level, the vast majority of Solana's trading volume is just pump fun with 6 billion. So 6 out of the 8 billion are pump.fun, and that's 99.9% wash trading. This is not organic trading volume. Even that wash trading is coming down over time. This is the revenue of pump.swap measured in Solana tokens. There was all this excitement around the purchases of Ethereum through the ETFs and through the treasury companies. But this trend is also dying. In the last month, we have seen barely any change in the number of Ethereum that's held by the ETFs, so that's in blue, and the treasury companies, that's in green. We now have roughly 10% of the Ethereum supply in the hand of those two entities. When we compare this to Bitcoin, here the growth is much more steady. So the treasury companies are still buying very constantly, so are the ETFs. And when we add up the Bitcoin supply that's held by Wall Street, that's bigger compared to what is purchased for Ethereum. Let's run the numbers. We've got 1.15 million held by the treasury companies. We've got another 1.54 million held by the ETFs. So in total, that's 2.67 million. And we currently have roughly 20 million circulating. So it's 13.5% of the supply that's held by those two entities. More than what we have for Ethereum. And the growth is much more constant. So really, there's a good chance that Bitcoin will do better than Ethereum. The Bitcoin dominance is at the top, the Ethereum dominance is at the bottom. And there's pretty much an inverse correlation here, right? Because those two cryptocurrencies own the vast majority of the entire crypto market. When Bitcoin dominance is going down, Ethereum dominance is going up, and vice versa. And so if Bitcoin dominance goes up, Ethereum dominance is likely going to decline from here. That's my base case. The market is going risk off, Bitcoin dominance is likely going to increase. And the altcoins relative to Ethereum are likely going to come down. So again, the higher we go up the risk curve, the more losses I expect. This is total 3 ES, so that's the altcoin market excluding the stablecoins relative to Ethereum. Sometimes the altcoins outperform Ethereum by more than 200%, and sometimes the altcoins underperform Ethereum by more than 70%. And currently, the altcoins aren't doing that great relative to ETH. And probably they will continue doing so. And then the big question is what's going to happen over here. But before we hit this bottom, I think it's a bad idea to buy altcoins. Here's total 3 ES relative to Bitcoin. Again, I expect the altcoins to underperform Bitcoin by at least 40%. So this arrow here, that's 42, 43%. This, of course, is market cap comparisons, so it doesn't even show the entire picture. Most altcoin prices are going to do even worse compared to Bitcoin because of token inflation, new tokens hitting the market over time. Please don't forget this chart. The S&P 500 is at historical heights, and we don't know what crypto will do during a real crash. We've never seen such a crash during Bitcoin's lifetime. And really, the problem is that Bitcoin sells off when stocks sell off as well. Just have a look at the COVID crash over here and compare this with the Bitcoin price development during the time. Bitcoin also sold off, not just by 30%, but by 60%. So it was an amplified move of what the stock market did during the time. The stock market and crypto tend to move in the same direction at the same time. And if we expect that stocks have a hard time growing much higher, then Bitcoin and crypto as an extension won't be spared from this as well. The more risk there is, the more potential downside there is as well. Now, isn't it fascinating how for most altcoins, the movements to the upside tend to be much faster compared to the movements to the downside. We shoot up and then over a long time, we trickle down. Here's the example of Dogecoin relative to the others market cap. So when there's news, when there's a lot of attention, the Dogecoin price shoots up within 1 or 2 days to then come back down over several months. We're seeing the same for the Trump token. We shoot up. This was the announcement of the dinner. And then subsequently, we come back down. There is a difference though between Dogecoin and the Trump token once we zoom out. So again, this is Trump relative to the others market cap. So the market cap of all of these smaller altcoins, and here is Dogecoin relative to the others market cap. So while we do have our pump and dumps in both cryptocurrencies, the long-term trend is very different, as in Dogecoin just goes with the overall market. It simply just trades in a somewhat constant range, while Trump tends to long-term underperform. And there is a fundamental reason why Trump underperforms long-term, and that is tokenomics. It's new tokens that hit the market over time. Have a look at the following data. This is the number of Trump tokens that get released over time. We started off with 200 million. Now we are at 363 million. So it's the early investors, it's the team, etc. that cashes out over time. And that selling pressure, those vesting unlocks, that dumping on retail, that's what's creating the long-term underperformance. Now, some people say that markets are efficient and that everything is already priced in, but I don't think those charts show that. There is inefficiency, and we can simply turn this around. Let's say we've got Bitcoin relative to the Trump token. Then we're getting this chart here. So since Trump launched, Bitcoin outperformed the Trump token by 560%. This is how I believe we can make money in crypto. It's not trying to find the one outperformer among all those altcoins that always go down. It's doing the exact opposite. It's trying to be allocated in a way that we make money when the insiders and the early investors make money as well. When they are dumping on the average retail investor, we make money because things like Trump tend to underperform long term. As long as the token dilution continues, as long as new tokens hit the market, this chart is very likely going to go up. I'm making money with that strategy already for 4 years. This is a monthly chart. Had I just dollar cost average into Bitcoin, I would have gotten the return here in light gray. Instead, I got the return in black because I also bet on falling prices of various altcoins. It is a mistake just looking at US dollar charts. Really what matters is your portfolio value measured in Bitcoin appreciating over time? If the answer is yes, you're probably doing something right. If the answer is no, then you might just stick with Bitcoin and dollar cost average into Bitcoin and stay away from altcoins altogether. The Trump meme coin is just one out of many examples. Most altcoins have an increasing supply, and so here with Balancer relative to Bitcoin, so we go long Bitcoin, we bet on falling prices of Balancer, we can get this long-term chart. The strategy looks quite straightforward. There are a few caveats though. So for example, here with the Bitcoin to Balancer chart, we do have a lot of volatility along the way. Where does this volatility come from? It comes from small market caps. There is some token manipulation. There is some short squeezing happening along the way. And the smaller the market cap is, the more volatility we invite. So while the strategy is long-term profitable, we have to be aware of the potential pitfalls as well. And so I made dedicated videos on the topic. How can we actually make money from those inflating altcoins? Most altcoins do poorly and we don't have to find the needle in the haystack. The one altcoin that does well, we can just bet on the haystack continuing to go down because, again, the early investors, the VCs, they cash out and they dump on the retail investor. There are two important videos to watch: using perpetual futures on hyperliquid and risk management with relative valuation bets. It's half an hour each, so in total 1 hour of content. And after you've watched that, you know what to do in order to set up positions like this. Now, this here is currently my favorite trade. So this is the position that I will recommend to you once you have joined the premium membership. So you watch those two videos, you join the community. Afterwards, I will send you what to do in order to set up this trade. If you don't make money with that trade after holding it for 1 month, then I'll refund you your membership fee. I'm that confident in the strategy that you can simply just open that position, and if you're in the red, I don't want your money. The fee, by the way, is $125 per month. Again, if you don't make money with that trade, I will refund that. But of course, it's a monthly fee. So I share all of my trades in real time with the premium members. So for example, over here, this is where I closed a short position on the movement token. Move was also highly inflationary. We opened this over here where we were at the upper end of the trading range on a relative valuation chart. So we always look at the altcoin relative to the rest of the market. And then when we make quick gains, when we get closer to the lower end, we might also take some profit and wait until we go back again to the upper end of the trading range. I know at the beginning this strategy can be a bit daunting, but again, there is support in the different chats. There's also moderators that can help with any questions you might have. So feel free to check it out. The link is directly over here. Just click on the screen. It will lead you to the premium website. If it's the very first time here, feel free to subscribe. I publish these regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube, or see you in premium. Cheers.